Thank you, ma'am. We'd like to introduce you to our National Lunch and Learn. Once again, this is the third Tuesday of every month. Today, we are honored to be joined by Nate Pugmire and Mark Manthei, two of the top 1% loan officers in the United States and two very proud Summit Funding Next Level coaches. Today, they're going to be talking about non-QM products and how to get creative in this market. Gentlemen, we are absolutely honored that you're here with us. Take it away.
Wonderful. Thank you.
Appreciate it, Jones.
All right. Well, we appreciate everybody taking the time. And the goal today really is just to give everybody a chance to put 2 or 3 more deals on the board for 2024. If we can accomplish that, that will be a success. But I will say, from a standpoint of creativity, I consider myself creative, but then Nate is another level of creative, at least in my experience working with him over the years. So I think what we wanted to start with from talking with Nate the other day was just the mindset and how he approaches, lending from a solution-based mindset. And I'll let Nate start with that, and then I'll talk a little bit about that as well.
Thanks, Mark. I appreciate that. Yeah, I think probably more than anything, I approach every situation with a level of curiosity. And so I'm always looking for solutions. And I think that probably one of the biggest detriments that lenders have in general, not just in my office or really nationally that I've experienced, is that we have confirmation bias. We have our predetermined idea of what works and what doesn't work, and we try and fit everything into that. And a lot of times we're saying no to deals that can be done. And so I try to approach everything with, hey, how can this be done? How can I provide value to the client, to the realtor? And how can I transition this into more opportunities in the future? That's really the way that I look at every opportunity that comes my way. And I know, Mark, you and I have had a chance to talk about this quite a bit, about we also bounce a lot of ideas off of other seasoned people. So, I have people in my office that don't come ask me questions, and then you and I are having dialogue, high-level dialogue, that really, I think that's probably the biggest thing that's missing, is they're just not bouncing ideas off of other experienced LOs.
Right. When I think from a standpoint of like industry, some people have been in the business a long time. A lot of people got in the business the last few years. And from a realtor standpoint, understanding that, not everybody has the same box. Like some banks have a box, and it's very narrow and tiny little box to fit just that high level A paper into. And then you have lots of other banks that have bigger boxes to work with. And then you have private money, and that whole world of private money is 30% of the real estate market, which I would say 97% of realtors never actually ever tap into that product. And it's just lack of exposure to it, because if you never get exposed to it, and a lot of people get exposed to it currently in like the flipping business, a lot of the flipping money is coming from that world. But if you haven't been in that, then you wouldn't know to even look. So I think from a realtor standpoint, as you're helping your clients, a bank saying no is just the starting point, especially if it's a big bank. I mean, that is just the start of that person actually closing on a house within the next 90 days would be my opinion, because typically that's what we're seeing. They're with the big bank. We get the call, the frantic call, hey, they're, turned down. And then we get it, and they're just typically a couple minor moves to really get that person where they need to go.
Right.
So,
but I think about what you just said, how massive that is, though. 30% of the transactions will be done with non-QM. And I know that there's lenders and realtors that do zero, which means they're missing out on a massive portion of the market.
Right. And with that, in a market where, deals can be difficult to get, and we're heading into, of course, December, January, February. So there are people out there that want to make moves in real estate that don't even know that they can, and that's particularly like the business owner that's been in business less than 2 years. And we're going to get into some specific examples of things, but like huge opportunity. Business owner, less than 2 years, they're having great success, but they've got in their mind they have to be 2 years or 3 years in the business because that's what the bank has told them. Like, hey, get in 3 years from now, we'll be able to help you with whatever you want to do as long as your income, supports it. But that's not actually the case. So I guess it's a good time to talk. I think bank statement lending is probably the low hanging fruit in the in that that market right now because there's just so much of it. But Nate talked about where the bank statement loan fits for you and your clients and how you guys are using that.
Yeah, bank statement typically we're saving deals, right? We're saving deals that have gone to other lenders that have said no, and they just don't ask the questions. Hey, have they even explored what other options there are? Because you can do P&L income, you can do bank statement income 1 or 2 years. There are really, if you got enough money down, you could do no debt ratio whatsoever. If you have the right situation. So the biggest thing is you got to be curious and ask questions and find out what the entire situation is. And then also ask where they're trying to go. So a lot of times, a lot of lenders will just try and solve the initial loan and not look at where they're trying to be in 24 months. And there's multiple opportunities. And I think that you just got to ask questions. Really, we in coaching, Jimmy's the master at this, right? Tell me more about that. Oh, tell me a little bit more about that, right? Just ask those questions. They'll tell you if you just give them an opportunity to.
Right. Yep. And even with that, we're starting to see some of the credit unions around here are starting to work and kind of get in the non-QM space. But again, from a loan officer standpoint, it's our job to be the expert, know those programs, know those guidelines. And I can tell you from just being in that space, I mean, multiple people delivering bank statement loans, but every one of them has a different set of criteria of what they're doing. And we just recently doing a save where they got the quote was 11.5 from the credit union on a bank statement loan, which isn't something they do, but they were brokering it to a East Coast company. And that was just too much, even though the client is cranking a bunch of money through the bank accounts and putting 20% down. They were 25% down, 11.5. And then once we got the loan, we were able to put it, and we ended up at 8.875, and he's putting 20% down. So, and even though that's a high rate in our minds, for his situation, buying an $800,000 house, he's super happy with that because he knows he's been in business less than 2 years, which is why he was getting 11.5 rate. And he knows, he knows the math, and he knows that he can refinance out of that down the road. But it's more about providing a house for his family now and not waiting. But again, just educating your buyers to what is out there. And that's where, as a realtor, it's probably, a difficult time in a sense that like you really do have to know something about the lending world, or have great referral partners to plug your clients into, because you're generating those leads, and those leads are gold. But if you're not converting any leads, then you have no business.
Absolutely.
And ultimately, that's where having that non-QM piece, and figure you're increasing your conversion by 30% if you have a really strong non-QM partner.
Well, and to your point, you're talking about high rate, right? It's a high rate. A lot of them are self-employed. Almost all of them turn into a second loan at some point, right? So it's not just a one and done. You're getting multiple loans almost always on non-QM.
Right. And the one thing about the bank statement is typically self-employed. And so with that, it typically generates, referrals from their employees, as well as they're just more active. I mean, I've noticed my bank statement borrowers are more apt to do another loan, even though they're still in that bank statement loan. I've had a lot of them, just shift gears, do something, whether it's an investment on the debt service coverage ratio, which is a basically stated income loan for investment properties. That's another product that's probably underutilized right now, because in some markets there is some opportunity where prices have come off a little bit, but people are afraid of the lending side, and there's really it just takes that commitment to like, I want to do it. So as a realtor and a mortgage guy, I'm looking for people that like, I'm all in, let's figure it out. Because if that's the attitude, then you're going to be able to get something done.
Mark, tell me, how has that translated from your experience to getting relationships with other realtors?
Well, I mean, ultimately, every time you do a deal like that, that plants that seed, because you're doing, I mean, some of this stuff is, $1.2 million purchase deal, borrowers putting 20% down, and that's a nice commission check for anybody. Definitely that leaves a lasting impression, but that's just such a small percentage of realtors are getting exposed to any of that non-QM stuff, whether it is DSCR or bank statement. And then how do they take that to the street and really, let people know, which, to me, it's just really actively where like self-employed borrowers in the past, like you would almost steer clear of them. I mean, just so hard to get done because by the time we got done with their tax returns, it's just tough. And then you're just delivering bad news. And I know from a realtor standpoint, and I was in the real estate business prior, I mean, self-employed, you just knew it was going to be a lot of twists and turns, not always getting to the finish line. But now the current environment, like self-employed is the best because sometimes they're blown out of the water. You've got awesome tax returns. You can just go right at it. But even if they don't, they typically all have great cash flow. And if they got great cash flow, then that credit score determines what that LTV is. And ultimately, I mean, you're blowing them away when you're helping them into a house when they've only been in business a year. So, I mean, that's
Right.
like a target, like calling on new businesses would be a great tactic for, loan officer and realtors to start those relationships early, because ultimately they're in business because they want to be independent, but they also are typically there to make money, and making money to the big new house is kind of that, it's that first carrot on most people's, list of things to accomplish.
Right. Yeah. My experience has been when the realtor can come to you for the hard deals, you're much more likely to get the easy deals.
Yep. No, that's
Right.
true.
So that's kind of been the approach that we've taken on non-QM is, hey, how do we go solve the hard deals so that we can become the go-to for all the deals?
Right.
And it's been very, very powerful.
Mark, how fast can you guys close a bank statement loan? First question from the realtors behind me.
Bank statement loan with the sources we take to right now, I mean, we want 30 days, and they're just, the process is pretty simple on the initial. It's just that finish line is, we're not in complete control on the broker channel, so it's a little different from that end, but 30 days is a reasonable time for closing a bank statement loan.
Yeah,
Mark,
another
go
of
ahead.
the, oh, go ahead.
Please go ahead, Nate.
I was gonna say another of the tools that really is underutilized is bridge financing. So in a lot of cases, if you've got the right situation, you've got a property that has high equity, you can do a cash purchase on the acquisition property. They can use the cash purchase as an opportunity to get reduced cost or reduced price, which more than covers the cost of the bridge. So I've seen, where they get a 5% reduction, it costs them 1.5 for the financing, but they save 5% of the purchase price. So it actually saved them money doing the bridge than it did selling the house, trying to get a house accepted contingent, which is very difficult to do. At least in our market, it's almost impossible. And so, you gotta have solutions that create opportunities for additional value besides just, hey, yeah, we can close it in 30 days. If you do it right, you can close a bridge in 10 days.
Right.
So boys, one of the questions that just came across my text, with the realtors that are here with these products, the bridge and the bank statement loans, how can they use it for their advantage, and how could they be out bringing more deals to them during this market? Because that's absolutely the big thing that they want to know today is how do they put more deals on the board with these products?
Great question. Go ahead, Mark.
Yeah, I would say like with the bridge, we do a fair amount of bridge. I mean, bridge is just a great competitive tool. So it's the, $800,000 house that is just not going to take a contingency. They don't want to mess around with that. And your move up buyer that has good equity is able to make that move. So what we typically do on the bridge is like, we go in, we're pre-approved for the bridge. I mean, the goal is to avoid the bridge. It's an expense. If we can
Absolutely.
avoid it, we're going to. But from the seller standpoint, a bridge just guarantees the closing date. So what's your closing date? Whatever that is. Okay, bridge is in place. We're ready. In the meantime, we're going to try and sell the house and just close with normal financing if we can, or all cash. Sometimes they own the house outright. But what the bridge does, it makes you a cash buyer, and you can compete against that cash buyer. Because a lot of times it's the really great properties where, all cash, especially the higher price point, people will they will take the all cash. If it feels like cash and looks like cash, that's what they're going to do, even though you might be higher in your offer price. So from a buyer's agent standpoint, it's just a better way for you to guarantee your client's going to actually get the deal. And ultimately what I find in that, we explain the cost, and the bridge has roughly, 15 grand in expense on an $800,000 house that they're adding to their side of the ledger when they go through a bridge to a perm. They're just like, yeah, no, I want the house. So that's what matters. And a lot of times people just don't even understand how that bridge works. It is a relatively easy product to put together if the seller has enough equity.
Yeah. And as far as like, I try and do like elevator pitches, try and coach people on elevator pitches. What kind of things can you use for an investor? Like one of the things is, hey, I don't have enough income to qualify for a rental property. They don't realize that you can do a DSCR and it's not even income driven. It's completely driven by the rental of the property. So that's one that a lot of times realtors don't understand, and they certainly haven't passed on to the client, is that, hey, look, you don't necessarily have to have high income. You can do it through this DSCR. Bank statement, self-employment, people believe that they can't qualify. They don't even look. Whereas if a realtor is asking the right questions, they can create the interest and then schedule an appointment, and then you're solidifying that relationship, creating more value, and it creates more opportunities, because when you solve a transaction that they think isn't possible, they're gonna pass your name on to other people. It's going to be multiple deals, right? The great deal is when you solve problems that people aren't thinking are even option, you're going to get referrals. My top 4 referral partners all came from solving problems for other deals. And then because I solved those problems, they now refer me everything.
Yeah,
right? Like the elevator pitch for the AIO, for instance, is another non-QM, right? First position, HELOC. One of my elevator pitches is, hey, if I could show you how to have an effective interest rate of less than 3%, would that change the way you look at this environment? Everyone says yes, which gives me an opportunity to have the meeting, right? If I can have the meeting, then there's a good chance that we're gonna get the close.
So boys, can you back up in the chat screen the DSCR? Can you explain the terms that you're using? Make those concepts more clear. Not everyone knows exactly what that means. Help us be able to go out in the market and use them.
Yeah, great comment, Sean. DSCR is just an acronym for debt service coverage ratio. So it's the amount of the rent, and most of them want you to be about 1%. So in other words, if the rent is $2,000, they want the payment to be $2,000. You can technically go, I think, to 75% of the payment, you'll have a little bit higher rate. If you have a debt service coverage ratio that is higher, in other words, if the rent is $2,000, the payment's $1,800, then you're getting more favorable rates.
And that is I mean, we're seeing more and more of that. Yeah, but you can do, and then there with a bigger down payment, there's a no ratio on that where the rents do not matter.
Correct.
So
correct.
I mean, that's a great way for people, especially if you find a deal out there, they've got something they're buying at a discount. That DSCR product has a prepayment penalty. That's really the only downside to that as an investor, and you're locking in typically a higher rate. But if it pencils out and it's cash flowing, then you move forward, buy another one. I think there's some product like particularly like flip product where you can buy acquisition plus your repairs, and you can you're financing 100% of that project. You're putting money down in the form of a CD into the bank. And this is a product used for people that if you got clients out there that want to do lots of units and they're buying, basically flipping to themselves. There are products out there where you can pretty much keep your acquisition indebtedness at 100% of what you paid and what you put into it. And then as long as you're buying those deals at the right price, you're able to build out and do multiple loans throughout the year or multiple purchases. And we do have, clients in our market that are successfully executing on that type of financing, product. I mean, there's just so many options out there to get deals done and to put yourself in a good position as a buyer particularly on investment right now, just because the banks still want to lend and the demand is down. So they're getting more creative with what they're willing to do.
John, did that answer that question? Okay. So,
and I think with how you're selling that, it's basically a stated income loan, which for a lot of people that perks their ears up. They do like to hear that, because if you were in the business, in the 2003 to 2008, very popular strategy. But ultimately, it comes down to creating capital and leveraging it into the market.
Right. I think that the other thing that, when people think they do correlate to that 2003, 2008, all those junk loans that caused all the problems, right? Well, the difference is you're not doing 100% stated anymore. You're going to have skin in the game. You're going to document that everything actually pencils. It's, you don't have 100% investment properties that stated.
Right.
But there are solutions if somebody has capital. The other side of creative lending also goes to, Mark, you and I had this conversation on a what was it, an FHA or a conventional loan just last week.
FHA. Yep.
It was FHA, right? And it's understanding that there's a lot of nuance to lending. And if you want to kind of touch on the circumstances, it was a little bit unique, but it was a deal that wasn't going to happen, and you figured out how to get it done. Right.
And that specifically was a purchase, fiance. So our borrower and his fiance wanted to buy a house, and there was some income issues with our guy, and so we ended up incorporating the dad as a non-occupying co-mortgager. So FHA with a non-oc co-mortgager, they're all three on the contract. But where we got in trouble is that underwriting didn't feel like because it was his dad and his fiance didn't have a relationship with the dad. I mean, what they would say a legal relationship. Then the pushback was, hey, we can't do the loan. I mean, the loan's not going to be insurable with FHA. So, which is a problem because, we were in underwriting, appraisals in, and we were moving down the line. Felt like we had a good deal, but it is one of those deals where we were just flat out told no. Like underwriting came back and said no. So, but I mean, that's where I think one of the things probably both Nate and I do is we just don't really take no on a loan without digging deeper. And then, one, looking for what other options do we have, reaching out to each other, talking through it. I mean, just you really just have to be tenacious with those deals, especially you get a deal that, if it makes sense or you feel in your gut it makes sense, then it probably makes sense. And so how do you figure it out? And so we looked at different ways to restructure the loan, but ultimately came back to, pressing on that family relationship. That in the world of lending, fiance is considered a relationship that's acceptable, and that's been the case for a long time. So why would that not be the case with a, non-occupying co-mortgager? So once we got into that, we got legal involved, and we have a great legal counsel at Summit that's helpful in figuring those things out. And then he deep dove into it and then came back with his opinion on it. And his opinion was that's a familial relationship, and that does meet the, the letter of the guideline, or like Nate said, it's a nuance, but they felt and wrote up that, hey, let's go. And so, yeah, it went and we got it done. So, but that's definitely a deal that could have died if we had taken that initial no from underwriting.
Mark, do you have anyone that you refer, like banks, thing like that, for property stuff you don't do?
Yeah, no, we do. Like, we don't have a great lot loan, so we refer, lot lending out to some community banks here locally.
Right. And we do the same thing. Hey, if someone asks about lots, hey, yeah, we can help you get a lot, and then we connect them. Right. I don't want to say no and go find somebody. I want to know that, hey, come to us. We'll get you in touch with the right people.
Yep.
We'll get the lots done. So we're doing that as well. That makes a huge difference.
So
Yeah,
boys,
I mean, that's part of being. Oh, go ahead.
What out there can't you do? I mean, if the realtors are out there looking and they need to send to one of those loan officers, or we need to be creative, what have you found out that you cannot do or cannot find a home for?
There's not much.
I mean, it's crappy credit with no down payment. That combination is a tricky one. But if they got money to work with, then the credit becomes not a big deal. I mean, there's going to be a way to get it done.
Yeah, I mean, you can do foreign nationals, I-10s, bank statement. I mean, there's just so many ways to do things. And there's so many situations that I hear people say no to all the time that come to us, and we provide solutions. There's opportunities with, I mean, in my opinion, there's a ton of opportunity with builders, especially smaller builders, to go out and provide a ton of value to them, because the banks have really constricted about how much they're willing to lend. And I know Mark's had a ton of success. We've had a ton of success dealing with builders and helping secure financing for them to go vertical. And then we're the preferred lenders when they build. Mark, you want to touch a little bit on that?
Yeah, no, I mean, that whole world of builder lending, and it's expensive. I mean, these builders they're not borrowing money at 4%. I mean, they're borrowing millions of dollars at 10%. So the pressure is on, and they're motivated to, turn that inventory. So, and then this market being as difficult as it is, they tend to look at their realtor, and if things aren't going great, then they're always looking to make a change. So, I mean, that's just opportunity from the real estate standpoint. And then from the lending standpoint, being solution based, like a lot of times it's like, I mean, we do a ton of credit repair to make deals go. And that's more for your borrowers that are doing like 3 and 5% down. They don't, they've got a credit problem, and it could be a 615 credit score, but the bank has a 620 hardline overlay or a 640 hardline overlay. And so we're just taking those deals, doing a rapid credit update, which is a super common, play in the mortgage banking world, but it's like illegal, or not illegal, but banks will not do it. So like a bank, you come in, your credit drops below the requirement, it's just done. They can't do anything with it. So we take those deals, fix the credit, and get it pushed through. I mean, that's like super easy stuff. That's where those no's out there, when you've got your client and they've been told no, and they just went to a depository bank, 95% of the time they are a yes, if they just sat down with the right lender that could either look at rescoring, or, hey, let's move the car loan to your dad for the next year. I mean, there's creative things we can do to help the borrower qualify that are within the rules of the game. I mean, a rapid rescore is not illegal. It costs us money to do that, but we do a ton of that because there's a big difference between, a 618 and a 620. I mean, they're just how the business works. All these programs are available at 620 that aren't available at the 618. So I think rescoring credit and helping helping clients understand that is a super big opportunity for loan officers and realtors.
So Mark, Nate, question from Chris Clock in Tennessee. How can this relationship with smaller builders help our realtor partners that are attending the day? We're looking for a couple of tactics the realtors can take away that will really advantage their business with what you guys do.
Absolutely. The smaller builders especially have been impacted dramatically by the banks tightening. And so what we're seeing is the smaller builders are just simply being pinched. So if you can provide solutions to help them get vertical or horizontal construction, it's the difference between them being able to transact or not transact. And a lot of times there's also lots in play, whether they can do horizontal infrastructure. There are less lenders that, in fact, most banks will just simply not do that for a small builder. We have lenders in place that we can help them facilitate, get horizontal money, get vertical money. And if you can help a builder secure funds to be able to build, that's huge value from a realtor, right? So if a realtor is putting you in a lender in touch with builders and you're solving it, you've just solidified both sides of that relationship. It's a huge win. And I know Mark and Andy have done a ton of stuff with builders, and we're talking about significant numbers of lots. How many lots are you guys looking at? And you guys would be the preferred lender on all of it?
Oh yeah, we got over 1,000 lots on that deal.
So there's a massive number of lots and a huge opportunity and a tremendous amount of money being made because you're adding value where builders need it the most right now, which is capital.
And the other thing is, like, they really need, like, they do generate leads. The great thing about builders is they just generate just leads. I mean, they get lots of leads, and as a realtor that really does a good job of managing those leads, I mean, that's where you can really, managing those leads closing into their spec, or managing those leads into custom construction deals, or build on your lot situations. Again, that's, that is a huge help. And then with the lender side and that relationship is, having ways to put the financing together, whether it's getting a construction loan for the buyer to build on their own lot, or getting spec money for your builder. I mean, that relationship is, you can't have 10 builders. I mean, you really got to focus in on one or two that you can really do a good job with. Yep. But super valuable. And once you do a good job with the builder, I mean, they're very loyal if you're taking care of their business.
So Nate, Mark, here's an interesting question. If you were a realtor today and knew you have the strength of these programs behind you, the think outside the box programs, where would you start marketing or making sure that clients knew that, hey, you can help them? How would you get out in the street?
Go ahead, Mark.
You want me to take that first?
Take that first.
Yeah, I mean, right now, because there's a lot of turn down business out there. I mean, it's about getting out. If you're going to work, some of the bigger production builders have the on-site salespeople. So from a lender standpoint, you're looking for that turn down business. As a realtor, you're going to be focusing on those smaller groups, but you want to have introductions to those bigger players, because those guys will, they're faster to change hands than a smaller builder. They just have no tolerance. If things aren't going good, they just start changing things, regardless of whether the realtors are doing a good job for them or not. I just know with some of the builders that we've had that have, none of them are happy with their realtors right now, only because the sales are not there. I mean, and again, that's not necessarily the realtor's fault, but it's the, the timing. They're just looking for somebody to come in and give a fresh perspective, attitude. And so that opportunity to come in is really good right now with small builders, but I would not walk past the big builders. Anytime you get a chance to get introduced to one of the bigger builders, those guys they're normal guys, but when they have 1,000 lots, everybody's afraid to talk to them. And you definitely want to be on their radar because it just creates opportunity. You work in that circle. There's so much business done with those guys, whether they're building or flipping or building their own place. I mean, they're very active in doing deals. And I think that's like one of the best partners a realtor can have. But you really just got to get in front of them and just be creative. I mean, they're very much relationship, have a beer, hang out, play golf. That's just how they roll. They're not corporate. They're just they're real people. They like to have a good time. And you just got to, ultimately, I think that's more of not really a buddy sell, but in a sense, it's a little bit of a buddy. So you got to get in there and have a relationship if you're going to really, go deep with those guys.
Yeah, I agree. If I'm a realtor and I'm trying to get in with smaller builders, I think I would I would try and get an appointment with the builder and find out what they're looking for from a land standpoint. If you can bring land that works for them to develop, there's no better value you can bring as a realtor. Right, you're solidifying yourself for especially infills. If you're gonna have a 10 or 12 or 20 lot subdivision, those are a great way that you can go establish value, and it's not hard to do.
Chris Clark, I think you're asking, where do you find the builders? Is that correct? So gentlemen, while he's answering, I believe he's asking, where do they start going and finding these builders?
Yeah,
I mean, I would
search
go
your
ahead.
area, search your area for what builders are active. You can go to the Builders Association. You can check who's pulling permits. There's a bunch of different ways you can find out who they are.
Yeah, Home Builders Association, good. Even your lender, most lenders have at least 1 or 2 builders they work with. So talking to your lenders that and find out who they've got. You just need that warm introduction. It can go, I mean, it's always been warm lead with my builder stuff, where whether it's an agent that was working with them. I mean, that's just how that business works. Whether it's builders, and same thing with like property flippers. Some of these guys are doing 7, 8 houses a month in that property flipping game. I mean, those are great partners to get in with. And again, they if you bring them deals and help bird dog property, that's the best way to get in with those guys. They'll come in all cash, they cash the deal, they give you the listing back, and then you just start building that relationship. But builders and flippers, the great thing there is it's just repeat business. I mean, they just are constantly trying to do more and more business. And you never know when you're going to grab the guy that, does 25 deals in a year, which is what ultimately, is the gold mine everybody's looking for.
Right.
Boys,
I think to Glenn's point earlier, he brought up the assumable loans. Don't underestimate how much opportunity there is in assumables. There is a lot of opportunity. You may not make money on that assumable loan, but you can create a relationship by helping them solve a problem. I helped a client get into a house with $50,000 of equity. They didn't have time to sell it and wait for the realtors. They ended up $7,000 out of pocket at a 2.875 rate, and I've gotten 3 referrals from that situation. I made no money on, but I got 3 referrals from it. So don't let those pass you up. There's really good opportunities in those.
Well, and that assumable, because Symmetry will go behind those assumable loans now. I mean, you still have to hit that 90%. But you got 10% LTV and then structure that. There's some opportunity that's definitely some low-hanging fruit with assumable loans.
Thank you, Mark. You just answered a question from behind me. So they can get a second on the assumables.
Yep. Not every bank's doing those, but yeah, with Symmetries, which one of our partners is doing that now. That was real recent.
And Rolando wanted to know, will Symmetry second lien be a second loan?
Yes.
Can you guys, can I clarify that?
Yeah.
Please go right ahead.
So, because what I'm hearing on those assumable loans is that the second needs to also be assumable so that the first bank that's holding the loan, that's making the assumption, allows for both loans to be technically assumable. So my question is Symmetry's second lien assumable, or is that just bogus? They will allow that second lien to tie, because the thing is not so much that the assumption loan doesn't allow a second. It's I'm hearing that the most banks, when they allow a second to tie onto that, it also has to be assumable, and that's where we have the challenge of finding a second lien that's assumable.
Yeah, there's actually another way to solve that too. It's a little bit more cumbersome, but you're capped on your CLTV, right, at 89.99. So if your second isn't assumable, you can do the assumption on the first. And I'm trying to remember how I did this. So we closed on, if I remember, we closed on the first as an assumable, and then just refinanced the second.
Okay.
Does that make sense?
I think I follow. Yeah, yeah.
Because once the borrower's on title, they could use the appraised value and just refinance and it was just a refinance and they paid off the other second.
Got you. Yeah, it gets
But you-
tricky.
It's a little more
Yeah.
cumbersome.
Mhm. Thank
but
you.
There is a way around it.
Right, because Symmetry's product, they'll go in second position behind the new assumed loan. Your borrower has to put
He's
10% down.
referring if there's already a second in place. Which is definitely more tricky. You don't see it as often, but it definitely does happen.
Right.
And the biggest challenge with those assumable loans or wraps usually is the equity piece is too big for someone to come in with the cash they need to make the deal happen, right? So that's usually what the challenge is. If you can solve that, then it's a huge win. Then you can do owner carry, or you can do seller financing. There's multiple ways that you can do it, but you're ultimately going to be stuck at 89.99% if they want to do a second after the fact to pay it off or whatever. You're going to be stuck at the 89.99%. But if you do a cost average on the rates and you got a 2.87 and a 9% second, you're still going to be a 3.5% blended or 4% blended, which is still fantastic.
So Nate, next question. You're doing 8 to 10 of these this month, 16 loans in an environment that most people are happy with 3. Nate, with the realtors that are out there watching this, we want to make sure they leave knowing what we can do when they're out in a regular market. Put the builders aside, when they're in a regular market,
Yeah.
what things would be the best for them to look for or listen for, where they can pick up the phone, call their Summit loan officer and go, hey, I heard this on this lunch and learn. Could you do X? Or are you guys pretty much saying right now, throw it up against the wall and see if it sticks? But can you give us a couple things that the realtors can really be out there looking for, knowing that we can help them get it done?
Yeah, I think to Mark's point, other than really poor credit and no money down, there's a lot of solutions out there if you're willing to go dig. So whether that's DSCR, whether that's bank statement, whether that's I never can remember the letters for it, but the loan where you don't have to have any kind of a ratio whatsoever. I mean, there's a ton of options, but you just have to get exposed to them. If you have a borrower that's ready and willing to buy, and they have money to put down, there's usually a way to do it if you're willing to dig into it and they're willing to be a little bit patient.
And I think from a standpoint of like listing homes, I mean, having an understanding of, FHA and VA loans are assumable, knowing that information going in, I mean, you should have a pretty good inside track if you're the only one talking about using the assumability of their loan tied to a second mortgage where you can, because a lot of those loans are under 4%. And that's a big selling point in this market when you can get something under 4% on the bulk of the purchase price. Makes it a lot easier to sell the house. But from a listing agent standpoint, and you're competing because it's a competitive market, if you're the only one presenting that concept, it's going to make you, I would think, put you, on top of the list for somebody that knows what the heck's going on.
Yeah, a lot of agents don't realize that you can assume a VA loan without being a veteran.
Question behind me, what are you guys seeing for interest rates for hard money loans right now?
Hard money, well, most of the stuff we do is not necessarily hard money. It's more just non-QM. We're seeing anywhere from 8.5, probably 8.25 to 9.5, depending on what the risk factors are. Hard money, like true hard money, you're 12 to 15% typically, usually 2 to 4 points. And those, I mean, hard money deals we're only doing if there's a big equity play that or that's the only way to protect the asset. That's really the only time you're going to do that type of a situation. Right. I mean, there's very few hard money deals that I can't even. I think I did 2 lots. I did 2 lots where there was $200,000 in equity, and it didn't make sense. It made sense to spend the $50,000 because there was $200,000 that they were going to glean from being able to spend 50. So that made sense. But other than that, I just haven't done too much hard money. I don't know about you.
Yeah, I mean, we do the flipping, a little bit of the hard money. So, I mean, and I think from a real estate standpoint, like when you, as a realtor, I mean, kind of putting this in your, job requirements. I mean, you really should be flipping one house a year. I mean, that's something that, it just puts you in that game, and then it puts you out there kind of looking for those deals. You're not going to do 10, but if you do one a year and you're just constantly looking, because if you do a flip and you should make, 30 to 60 grand on a flip, that's a nice supplement to your income, but that flip will generate business. I mean, you're going to be
Absolutely.
working with contractors, and you're going to have people coming by the house and da 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 da. So leads, and just generates opportunities. So, figuring out how to do that. I mean, that's something else that, I help realtors, get into that flipping, that want to tackle that. Because with flipping, it really just comes down to finding the deal. I mean, if you find a deal that's really good, it's going to be a way to make it happen. You're going to get paid. You may have to joint venture with an investor on it if it's your first one, but those opportunities are out there right now. And I think that's something that people miss, is you really have to do one flip to decide if it's something you want to do. But to never do one is a tragedy.
Yeah, I think so too. I think it's also important to know who your wholesalers are in your market, because they come across deals and there are opportunities they can't take advantage of. You can win just by default, just by staying in touch with them.
So boys, if you had to give us just one tactic to leave with, we got 9 minutes. All of the realtors right now are just looking for any way to increase their business. Nate, I'm going to start with you first. If you were to have a brand new realtor sitting in front of you going, I like everything you said, where do I start? What should they do with this information, knowing now that there's not too many loans that we turn down?
Yeah, I mean, it's the whole, I mean, it's cliche-ish, but you got to go talk to people, right? That, it's interesting when I talk to realtors in this market right now, it's amazing how many of them just feel like they're on an island and they're just being frozen by fear, and just letting them know, hey, look, we're here for you. We can solve these problems. If you got something you want us to look at, and just feeling like they got someone that can help them try and navigate, makes them feel like they can get engaged, right? I think that's part of it right there, is just feeling like you're not on an island by yourself.
Mark, what would you say?
Yeah, I mean, I was a realtor. It's a darn hard job, I can tell you that for sure. I did it for 4 years when I first got out of college. And it's so my advice would really be, in this market, I mean, it's just the attitude is super key. I mean, you have to find a reason to be optimistic, and I will tell you what that reason is. One, rates are going down in 2024. Going to happen. So, and then two, prices of homes are going up. So that's a great reason for buyers to make a move. So you really just got to share that information. And if you need documentation on that, you can reach out to me. I mean, I put stuff like that together, but those things are going to happen. And with the lack of urgency in the market, where buyers are kind of hemming and hawing on the fence, when the rates drop 1%, that puts 5 million buyers into the market. So it is a market right now where it's still kind of competitive, but now you drop rates 1%, put 5 million more buyers in the market with the inventory we have. Now you really are not having fun as a buyer. I mean, to me, this market, even though the rate's high, I mean, at least you can look at stuff and like take a minute to make a decision. That will quickly change when rates start coming back down. And so I think educating your sphere on that is super important. But I think most important is just staying positive on the market and finding reasons why now is the right time. And I 100% believe that prices will go up and that rates will go down, which makes this, today, even with the rates where they're at, it's still the best time to get a deal in the foreseeable future. So that would be my take.
Boys, it's 12:55. Any last words for us today?
Yeah, I just think you got to be active through the end of the year. And to Mark's point, I 100% think that values are gonna go up significantly. And I think that the number was like 5 million more buyers from 8% to 7%. 5 million more from from 7 to 6, and then it went to like 12 million more when it goes to 5. So if rates go down and inventory issues, I don't know about you guys' market, our market is super tough. If inventory doesn't go up, prices are going to be a problem. So you could realistically have a 10% jump in price value next year if rates come down. You'll sure as hell be glad you bought if that's the case.
Mark,
Yep.
Nate, real quick, what programs should we pay for as a lender? List reports, bomb, etc. Is there one of them out there that's absolutely is a must?
I do list reports, MBS Highway, bomb. I mean, I do a lot of it. I think they all have great things. I don't know if there's any one that's like a must have. I like list reports a lot. I like MBS Highway a lot as well.
Right. Yeah, for me, I mean, that I'm on those same platforms. But I mean, ultimately the technology is like, it's just your phone. I mean, a flip phone is really probably the best investment for any of us to keep us from getting distracted. So ultimately it's avoiding, how do you avoid distraction? I mean, our whole world is about distraction. So figure that out and you're going to be super successful. So make sure you're spending time with people that can send you business or people that are buying, and stay off of the internet.
So for the realtors who are out there, don't forget your loan officer, no matter what state or city you're in, can get a hold of these two gentlemen. If there's ever something that your loan officer does not know, they can reach out to these gentlemen at any time. You can reach out to these gentlemen at any time, ask questions or pick their brain. Boys, we'd like to thank you very, very much for leading our National Lunch and Learn today. Happy Thanksgiving to both of you. Happy Thanksgiving to all. Remember, our National Lunch and Learn is always the third Tuesday of every month. So the third Tuesday in December, we'll be back. Mark, Nate, thank you very much for your time. We're honored to have you.
You bet, guys. Thank you.
Thanks, guys.